Greetings, everybody. Welcome to Liberty Call. I am Raymond Dahlman, your humble host. Today is Friday, June 23rd, 2023. Hope everybody's had a fantastical day out there in the interwebs. We've got clear skies here in Colorado, finally. Hopefully we got a little more rain yesterday. A tornado about 15, 20 miles north of me up on the south end of Denver took out some homes in the northern part of the county. So I hope they're okay. But we had like terrible hail again. And I mean, I thought the weather was extreme down in Texas. And I mean, while it is, we get rain and hurricanes and tornadoes and all sorts of good stuff. It's crazy out here, right? Because where I'm at, the mountains are like right there. And we're on the upslope right in front of the range. And you got some weird topography around here, which just makes the weather swirl. And it's crazier in the wintertime because, we'll get, if Denver gets a foot, we'll get 18 inches. If it's, 30 degrees in Denver, it's 20 here. So, it's a little more extreme just because of the weird topography here. Anyways, you didn't come here to listen about the weather in Colorado. You came here to hear about what happened this week in the financial world. Markets ended on a sour note. Other than yesterday, the rest the markets were down. Really been down since the Fed meeting last week when Chairman Powell said, "Hey, we're not lowering rates anytime soon, so buckle in, buckaroos." Anyways, all right, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, like, share, subscribes, follows, all that good stuff. Press all the buttons, share with friends. They may think, hey, this guy's got an awesome beard. I got to listen to him. Anyways, all right, let's jump into the numbers for today. Let's make that a little bigger so we can see it. All righty, the Dow Jones was down 0.64%, 218 points, closed at 33,728. S&P 500 was down 0.77%, closed at 4348. NASDAQ was down 1.01%, closed at 13,492. VIX was up 3.49%. It's at 1336 right now. Canada was down 0.83. Brazil flat, down 0.09. Mexico down 0.34%. Over in Europe, Germany was down 0.99%. UK was down 0.54%. France down 0.55%. Netherlands down 0.34%. Spain down 1.06%. Italy down 0.73%. Switzerland up 0.34%, the lone bright spot in Europe, and Portugal was down 1.3%. Both Russian exchanges in the red, MOEX down 0.74, RTSI down 1.53, and the overnights in Asia, most of the markets looks like they were still closed, but we'll cover the ones that were open. Nikkei in Japan was down 1.45, Australia was down 1.34%, New Zealand down 0.21%. And the Hang Seng was open today. It was down 1.71%. Everything else in the Asian markets was closed. So maybe it was a holiday. I don't know. A chicken fried rice day or something. I don't know. Okay. All right. Well, let's go ahead and look at where is it? There we are. Look at how the markets performed for the week, starting out with the Dow Jones. It's going to finish off the week down about 1.4%. The S&P 500 is going to finish off about 1.43 down. NASDAQ, it's going to finish off the week down about 0.83. The Dow Utilities down about 2.35. And the Dow Transports finished the week off down about 0.9. So looks like the whole week was pretty red. Let's zoom out and look at the big picture right now, going back to the beginning of last year. That is the current trend we've been in. Like I've said many, many times, with the Dow, it broke through this resistance line late last year and has just been trading sideways for the most part of this year. If we zoom in, we can see what day was that? That was Thursday of last week. That was the last up day for the Dow, and we've had nothing but down days ever since. Switch over to the S&P 500, similar chart. Beginning of last year, broke the trend in early January, traded sideways for a number of months. This uptrend, I think, had a lot to do with hope that the Fed would pause rate hikes and, be more accommodative to Wall Street and, corporate America, but that has not occurred. And if we zoom in, we can see the same similar chart that we had for the Dow, and I imagine, the NASDAQ looks the same way here in the last week. So Anyways, so that's what's going on in the world right now as far as the markets. Let's go ahead and jump over to the economic data that came out this week. Starting out with initial jobless claims, came in at 264,000. Forecast was 260, same number as last week. Continuing claims came in at 1.759 million. Forecast was 1.782 million. Last week's number was 1.772. So went down a little bit, and we're still fairly normal right now. It has trended up a smidge here. If we zoom in on the 1 year, it has increased a little bit. Zoom out to the 2 year. So like last year really was low. I mean, we had exceptionally low extended unemployment, but again, this isn't terrible. So I don't want people to think it's just gone nuts as of right now. Let's see here. Housing starts came in at 1.631 million. Forecast was 1.4. Last month's number was 1.34. So we can see here, big jump in the housing starts number for this month, probably because it's summer. That probably had a lot to do with it. Maybe some built up inventory. Also, I mean, granted, interest rates aren't helping the situation. I mean, if they were, not that I'm saying we should lower interest rates by any stretch of the imagination, it would cause more damage, to the overall economy. But, from the housing, from housing, most people, mortgage their houses. There are very few people are paying with cash these days. So, all right. Housing starts month over month grew by 21.7%. The forecast was to recede by 0.8%. Last month's number, it had retraced by 2.9%. Existing home sales for this month came in at 4.3 million. Forecast was 4.25. Last month's number was 4.29. So about the same as last month. Month over month grew by 0.2%. And last month's number actually contracted by -3. The leading index month over month came in at a -0.7, right on forecast. Last month's number was a -0.6. The Global Composite Purchasing Managers Index came in at a 53. Previous month was a 54.3. So it looks like it kind of peaked out last month. So we'll see if this trend, if it's tipping over, is it going to plateau, or is this an aberration? It's going to continue to trend back up. Easy for me to say. Alrighty, so that's all the economic data. Let's jump into the market recap. Stocks are falling after hawkish comments on rates from Fed's Powell. U.S. stocks experienced a decline due to concerns about interest rates following Federal Reserve Chair Jerome Powell's hawkish testimony to Congress. Powell stated that more rate increases are likely in the coming months, even though the Fed paused on raising rates the previous week. The futures markets indicate a probability of over 70% for a quarter percentage point rate hike at the next Fed meeting, July 25th and 6th. Atlanta Fed President Raphael Bostic emphasized that the central bank's top priority is to combat inflation. Bostic stated that, quote, "Getting inflation down is job one. Inflation is too high," end quote. Other Fed officials, such as Chicago Fed President Austin Goolsbee, moron, have advocated for patience to assess the effectiveness of the Fed's auctions thus far, as the impact of monetary policy can take time to manifest. Mr. Goolsbee is a fool. I know he is, considered smart. He's intelligent. He worked in the Obama administration. I find him just to be a hack who does whatever his overlords tell him to. Richmond Fed President Tom Barkin expressed uncertainty about inflation's trajectory towards the Fed's 2% target and stated that he is still waiting for clarity. San Francisco Fed President Mary Daly believes that 2 more rate hikes this year are a reasonable projection, highlighting the importance of proceeding cautiously given the rapid rise in rates. In the stock market, 3M company shares declined by 0.1% following the announcement of a $10.3 billion settlement with U.S. Public Water Systems regarding claims related to, quote, forever chemicals, end quote. Conversely, CarMax Inc. shares rose approximately 9.2% as the used car retailer's cost-cutting measures helped it surpass market expectations for first quarter profits. Starbucks Corporation shares fell by 2.4% amid the possibility of a strike by unionized workers who claim that the company's prohibited Pride Month decorations in its stores. Aw, the poor mentally ill are sad that they didn't get to put up their rainbow decorations. Just terrible. So sad. All right. Finishing up, Powell's testimony and the indication of further rate increases contributed to the market's decline as investors became wary of potential impacts of borrowing costs and corporate profitability. The statements from various Fed officials added to the uncertainty surrounding inflation and the central bank's future actions. These factors, along with specific company news, influenced the movement of individual stock prices during the trading session. End scene. Yeah, so is what it is. All right, diving a little deeper, forecast shows U.S. earnings decline in the second quarter. That is not positive news. Forecasts for second quarter earnings of U.S. companies continue to look bleak despite stronger than expected first quarter. The likelihood of further interest rate hikes this year adds more potential risks for businesses. Analysts anticipate a 5.6% decline in earnings for S&P 500 companies in the second quarter compared to the same period last year, according to data from Refinitiv's IBES. In the first quarter, earnings grew 0.1% year over year, surpassing the earlier projection of a 5.1% decline at the start of the reporting season. Positive results from major companies like Microsoft and Apple contributed to the improvement. If earnings were to decline in the first quarter following a 3.2% drop in the fourth quarter of 2022, it would mark the second consecutive quarterly decline, leading some strategists to describe it as an earnings recession. That's in quotes. The previous one occurred in 2020 when the COVID-19 pandemic impacted corporate performance. Although the second quarter earnings season is set to begin in mid-July, it's becoming evident that the Federal Reserve is unlikely to have completed its tightening cycle. Fed Chair Jerome Powell indicated that 2 more 25 basis point rate hikes are a reasonable estimate if the economy continues on its current trajectory. Other Fed officials have expressed similar views, with interest rates rising by 5 percentage points since March of last year. The Fed recently paused to evaluate the impacts of its actions. Higher interest rates lead to increased borrowing costs for businesses and consumers. Investors are concerned that that an extended tightening cycle could push the U.S. economy into a recession. Well, hey, newsflash, all the smart people are already saying that. So, I mean, that was something that was on the table last year, and I'm not sure how they're going to get out of that. Other central banks, such as the Bank of England, have also raised rates due to global inflation concerns. Yeah, and we talked about this yesterday. Europe is a mess right now. Some strategists believe that as long as employment remains high, U.S. earnings will hold up reasonably well. Full employment suggests that even if consumer attitudes shift and spending is curtailed in certain areas, individuals will continue to participate in the economy. Oliver Persh, Senior Vice President and Advisor with WealthSpire Advisors, noted that corporate earnings are likely to outperform expectations because they are already set low. While Walmart raised its annual sales and profit targets due to resilient consumer spending, other companies have provided less optimistic outlooks. FedEx reported disappointing quarterly earnings, citing weakening global demand and pressure on profit margins. Darden Restaurants, the parent company of Olive Garden, delivered a disappointing annual profit forecast. Morgan Stanley expects margin pressures for Nike due to an inventory glut. Nick Raish, CEO of the Earnings Scout, expressed concern about an overly optimistic market expectations regarding the Fed's ability to control inflation, avoid recession, and reduce interest rates. He suggests that the S&P 500 earnings estimates and stock prices may need to be adjusted downward. Despite a 1% decline in the S&P 500 for the week, the index remains up more than 13% year to date. Well, it was down quite a bit last year. So, I mean, if you're just looking at the year-to-date number, if we go back to the beginning of last year, all the major indexes are down anywhere from 5 to 15%, I think, last I looked. All right, last up, if you've been wondering why home prices have gone through the roof, hey, here's a potential culprit. Fraudulent COVID aid drove up U.S. house prices, report says. This comes from the Wall Street Journal, written by Richard Vanderford. All right, a study conducted by researchers at the University of Texas, horns down, has found that fraud against the Paycheck Protection Act, the PPP, had a significant impact on real estate prices in certain U.S. zip codes. The researchers concluded that the abuse of the program, which aimed to support businesses affected by the COVID-19 pandemic, was largely facilitated by some financial technology companies that provided the loans. The study revealed that house prices in zip codes with high levels of fraud were 5.7 percentage points higher than in low fraud zip codes in the same county. Even after accounting for some other factors, the research suggests that individuals who received fraudulent loans were more likely to purchase homes during the program, leading to an increase in home prices for the surrounding areas. The findings shed light on the broader economic impacts of fraud, which have received less attention compared to the focus on fraud's effects on government finances. Samuel Kruger, an assistant professor of finance at the University of Texas, horns down, highlighted the negative spillover effects of fraud, emphasizing that it not only involves stealing money from the government, but also contributes to market distortions. The study's conclusions could lead to increased scrutiny of regulators and the financial technology sector, which played a significant role in providing loans under the PPP. The researchers noted that some fintech companies appeared to have taken a lax approach to controls, potentially contributing to the prevalence of fraudulent loans. Previous research by the same team found that fintech companies were involved in over 80% of PPP loans by May of 21. Estimates suggest that around $117 billion in fraudulent loans, equivalent to 15% of the total funds distributed, were issued during the program's duration. The House Select Committee on the coronavirus crisis concluded last year that tens of billions of dollars were likely given to fraudulent or ineligible applicants. Color me shocked. The researchers flagged loans as suspicious if they went to non-registered businesses, multiple loans were linked to residential addresses, or the loan amount indicated payroll figures significantly larger than industry norms. The impact of fraud on inflation persisted even after controlling for various factors. The report also suggests that fraudulent loans may have influenced prices for other goods, such as cars and luxury items, where the markets are more challenging to analyze. The researchers predicted that the areas most affected by fraudulent-related inflation would likely experience faster depreciation in house prices due to transient nature of the fraud-driven demand shock. While the fintech model itself is not seen as flawed, the study highlighted the significant variances among leaders, with some exhibiting greater diligence than others. Regulators have prioritized investigation into fintechs, as those entities often fall outside the direct oversight of traditional banking regulators. Efforts to regulate fintechs are ongoing as regulators seek to address potential risks associated with their operations. So, hey, 15% of all that PPP money went to defrauding the government, and it got spent. I mean, I was watching Narcos last weekend, and I'd never seen it before. Pretty good show. A lot of reading because most of it's in Espanol. But anyways, they have all this money coming in, billions and billions of dollars, and they got to stick it everywhere. So what's his name? Escobar. He winds up buying like damn near every house in the country. I mean, he's moving around from place to place that he owns. And he's got, just got to do something with all that cash. You just can't he did bury it in the ground, but and some people found it. But anyways, that's kind of the problem. You have all this influx of cash, whether or not it's legitimate or not. And, it distorts the markets from houses to cars to food to gasoline to everything else. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. Hope everyone has a fantastical weekend, and I will talk to you next time. Adios.